Alrighty.
Welcome. Today we're going to peel back the layers on a really fascinating and absolutely critical area of corporate tax, the acquisition of control rules. This is where business strategy and tax law really collide. And for anyone involved in mergers and acquisitions, understanding these rules isn't just helpful, it's essential.
So, let's start with the puzzle that gets right to the heart of why these rules even exist. Why on earth would a successful, profitable company go out and buy another company that's just bleeding money? At first glance, it seems completely counterintuitive, right? But the secret often is hidden in the target company's tax history, specifically its accumulated losses, which can be a surprisingly valuable asset if you know how to unlock them.
Okay, so here's our game plan. We'll break this down into 5 parts. We'll start with the core problem the government was trying to fix. Then we'll walk through each of the consequences of an acquisition step by step. And finally, we'll put it all together with a practical example to really see how the numbers work.
First up, we need to understand the why. Why are these rules so complex? Well, without them, a profitable company could simply go shopping for a company with huge losses, not because it wants the business, but just to use those losses to slash its own tax bill. This is what we call loss trading, and these rules are the government's way of shutting that door.
So what's the trigger for all this? It's a specific event called an acquisition of control, or AOC for short. And this is more than just buying a bunch of shares. It's the moment when one person or group gains enough voting power to actually control the company's direction by electing the majority of the board. That's the line in the sand.
All right, so the deal is done. Control has officially changed hands. The very first thing that happens from a tax perspective is a sudden and dramatic stop to business as usual. The company's normal financial rhythm is immediately interrupted.
The rules impose what we call a deemed year-end on the day right before the new owners take control. So, if a deal closes on July 1st, the tax year is slammed shut on June 30th. This creates a really short, intense tax period where a lot of things have to be sorted out and fast.
And during this deemed year-end, the company's past losses face a moment of truth. And as you can see, it's a tale of 2 very different outcomes. The net capital losses, they're gone. Poof, they vanished forever. They cannot be used. Non-capital losses, on the other hand, which usually come from day-to-day business operations, they get to survive. But they're put on a very tight leash. They can only be used to offset future income from that same business or a very similar one.
Okay, so the year-end is forced, the fate of the losses is decided, but we're not done yet. The next step is that the company has to take a good, hard look at the value of everything it owns.
And this isn't optional, it's mandatory. The logic here is that the government wants the old company to recognize all of its built-in losses before the new ownership takes the reins. So if any asset is worth less on the open market than its value on the tax books, a write-down is forced. The interesting thing is, this actually creates more tax deductions, deepening the company's loss right before the change of control.
Now, up to this point, everything we've talked about has been about rules the company must follow. They are mandatory and often painful. But this is where we pivot. This is where we move from compliance to strategy and where things get really clever. The company gets a unique opportunity to make an election. It can choose to create taxable gains on its assets that have gone up in value. Now, you might be thinking, hold on, why would anyone want to create more income? Well, it's to use those very tax losses we just talked about, especially those capital losses that are just moments away from disappearing forever. It is a classic use it or lose it scenario.
So here's how it works. This election lets the company essentially sell an asset to itself at a higher value. This creates a gain right now, which is then immediately soaked up by the existing losses. But the real prize? This also creates a new, higher cost base for that asset going forward. And a higher cost base means bigger tax deductions for the new owner in future years. It's a brilliant way to create a future tax benefit.
All right, that's enough theory. It's one thing to talk about these moving parts, but it's another thing to see them in action. Let's walk through a case study and see how the numbers actually tell the story.
So, here's a snapshot of the assets of the company being acquired. We can see what they paid, what their current tax value is, and what they're worth on the market today. And as you can see, it's a mixed bag. Some assets have lost value, but others have appreciated quite a bit.
First things first, we have to deal with the mandatory part. The equipment is worth less than its tax value, so we must recognize that $40,000 difference as a write-down. No choice here. This gives us an immediate tax deduction in that short year. Now comes the strategic play. The company elects to bump up the value of its appreciated assets to fair market value. Look at what this does. It creates $76,500 in new capital gains and $105,000 what we call recapture, which is basically treated as business income. We've just manufactured income for tax purposes.
So let's put it all together. The company started with a $48,000 business loss. We then factor in our adjustments, the recapture income minus that mandatory write-down, which actually flips the company into a small business profit. Then we add the capital gains we created, bringing us to a net income for tax purposes of $93,500.
And why did we go through all that work to create $93,000 in income? To use these. The company had a pool of pre-existing tax losses just sitting there, waiting for a purpose.
And here's the payoff. We take the income we just manufactured and we use the losses to wipe it out. First, we use every single penny of that $32,000 net capital loss because we know it's about to expire. Then we just dip into the non-capital losses for the exact amount we need, $61,500, to bring the taxable income down to a perfect zero.
So let's look at the final scorecard. The net capital losses are gone, yes, but they did their job perfectly instead of just disappearing. And what's even better, we still have over $100,000 in non-capital losses that have been preserved, ready to be carried forward and used by the new business. That's a huge win.
And don't forget the second part of the prize. Thanks to those strategic elections, our assets now have a higher tax basis. This step up is incredibly valuable. It means the new owner gets to claim bigger and better tax deductions, like depreciation for years into the future, creating a powerful long-term tax shield.
So, to quickly recap the critical points, an acquisition of control forces a deemed year-end. This is a huge event, where capital losses expire and non-capital losses become restricted. There are mandatory write-downs you have to deal with, but the key is the strategic election. It's this powerful tool that lets you absorb those expiring losses and create future tax shields.
And this really leaves us with a final important thought. These rules are, without a doubt, complex, but they aren't just a compliance headache. For those who understand them, they're an opportunity. It really shows the difference between simply following the law and using the law as a strategic tool to actively create value in a deal.